Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, tech is back, leading the charge on Wall Street. Futures are pointing to gains, and the market's looking to end the week on an upbeat note. Chips leading the way as the key semiconductor index is coming off of a record high. And helping lift chips again this morning, the US Taiwan trade deal. A key part of that agreement, building more semiconductors and chip factories in the United States. Taiwanese chip and technology companies will invest at least $250 billion in the U.S. for production capacity. And in exchange, the U.S. is limiting reciprocal tariffs to 15%, down from 20%. With the rising cost of electricity tied to the AI build-out, the White House is looking to take action. The Trump administration reportedly teaming up with a bipartisan group of governors to pressure an electricity grid operator to hold an emergency power auction just for tech companies to bid on contracts for new power plants. But it's unclear if that plan will move forward. The grid operator was not invited to attend that event at the White House. Getting a check in on stock futures right now. We are seeing a little bit of dispersion here between the Dow and the NASDAQ 100 futures. Dow futures only up marginally here. NASDAQ futures indicating a gain of about 0.5% at the open, illustrating a little bit of a comeback in tech, although this year thus far, tech has still been lagging. And Wall Street is wrapping up a volatile week as earnings season kicked off. Stocks coming off a winning session, snapping a two-day losing streak. But with valuations continuing to climb, we're dissecting how to navigate the markets with Oppenheimer Chief Investment Strategist John Stoltzfus. John, it's always good to see you. Thanks for being here.
Thanks for having me on the show, Julie.
So, John, it has been an interesting few weeks of this new year, to say the least. But let's sort of zero in on earnings and what we've been hearing so far from the bank stocks. What is this telling you about how earnings are going to go and whether that's going to continue to sort of propel stocks higher?
Well, Julie, it's still too early really to judge the direction of the whole earnings season with really things just getting underway with the big banks. But we've got to say, with just about 5% of the companies, a little over 5% of the companies having reported thus far, I mean, my gosh, this looks like we're going to have a good earnings season, and a lot of surprises that are positive surprises. I think it's 82% are positive surprises. And we think the guidance is good. Some of the selling we've saw on good news, pretty typical of late. The traders seem to sell things. They sell less harshly on good news and positive surprises. And of course, they'll trounce something that disappoints. Even if guidance for the forward is better, they're show me. It's we're from Missouri kind of attitude.
Yes, definitely. John, as somebody who is pretty darn bullish for this year, I believe you have one of the highest, if not the highest, targets for the street. I'm curious how you're thinking about this year differently from last year, or if you are. Like, is the same playbook going to work this year?
It's a similar playbook, but it's a broadening playbook, and we've seen the broadening really goes back to the fourth quarter of 2020, when it had been a bear market kind of year, and the market got trounced on a lot of negative pitch book stuff that was never realized. Earnings recessions and unemployment and recession, all that didn't happen. But the bounce showed an interest in things beyond tech, but with tech in the leadership. But it's become much more pronounced now. I mean, if you just look at what the market has done so far this year, I'm looking. Materials are the best performing sector year to date, up over 7%. Industrials nearly 7% up. Energy up 6.5%, and staples up 5.7 or 5.3. No, 5.7. It looks like I need reading glasses. But anyway, what we're seeing is a rotation, and it's not necessarily away from technology, as we would think. It's some profit taking to broaden one's exposure and diversification. And then the smalls and mids are doing great. They are essentially outperforming stateside with gains. Mid caps up 6.4%. The S&P 600, a better quality small cap, up 7.3%. And the Russell 2000, when the tide comes in and all ships float, up 7.76%.
I mean, it's been pretty remarkable to see that Russell 2000 make new highs and to see some of that other rotation that you're talking about. But John, man, we've been talking about broadening for a long time. This is something I've been talking to you about. I've been talking to other investors about for a while. And we've seen these sort of little feints at doing this broadening that then have faded. And so I guess the question is this a more sustainable broadening than what we've been seeing over the past year?
We believe it is. We believe that at this particular stage, we're beginning to see, if you just consider, what was it, the most recent GDP number, I think the third quarter came in at 4.3 versus 3.8 or something like that expected. It's the economy is showing resilience and strength, but not robust. We don't want to see robust. We like resilient, great operative word. And then in terms of corporate earnings, managements are doing well in terms of the consumer. Soft data, of course, can tend towards the negative, but the hard data shows the consumer keeps shopping, even though perhaps they've toned down the volume of spending. But at the same time, they still shop because in the U.S., we judge our jobs and our dedication to things on what we can buy, indeed, for ourselves and for our loved ones.
John, do you think that if the broadening is going to stick around, are you participating in some of the buying in some of these groups that you were just talking about, materials, industrials, even energy?
Right now, we hold positions in all 11 sectors. Our overweights tend to be infotech, communication services, consumer discretionary, industrials, and financials. But we also hold positions that are slightly overweight where the market is in energy stocks, as well as we have positions market weight related to utilities, as I recall.
And if I, as a bullish guy, as an optimistic guy, I think probably by nature as well as by profession, John, if I was to pin you down and say, listen, what could go wrong this year? What do you think has the highest likelihood of going wrong this year? What would you say?
Well, first thing I would say is anything can always go wrong. It's always the unexpected that bites, right? But we'd have to think here that on expectations, it could be just earnings disappointments, all of a sudden a realization that technology's morphing process has reached a plateau, like it did during the tech bubble. Or it could be short term, very short term would be some kind of geopolitical rattle thing that would cause the market to wobble. But generally speaking, geopolitical risk turns into opportunity to buy shares because uncertainty tends to be profitable these days.
Yes, it does. And speaking of uncertainty, I mean, this year there's already been a lot of headline risk coming from Washington after a little bit of a lull. Do you, as an investor, just try to ignore that entirely? How do you handle it?
Well, one thing is we've noticed, as you know, I've been in this business. This year is going to be 43 years sometime between May and July. I've seen just about all boom, bust, and recovery cycles. In this particular cycle, the market tends to discount both good news and bad news very quickly. So we take comfort in that, but we would have to say the president's saying that he was going to try to cap at 10% credit cards, and now it looks not so much that he's backing away, but he's refining his thoughts on that, seem to assuage the market somewhat. Let's see how financials do today. And then the other thing would be we would consider, concerns related to the hyperscalers and just worries about when will all this investment of theirs become profitable. And we think the real answer to that is anytime you invest in a watershed change in technology, first you invest and you got to wait a while to make profits. So investors should really think patience may be what's required here. So we think there's a lot of offsets to the negative potentials.
And patience is always a good thing to remember, I think, when investing. Lastly, switching gears entirely, John, I think a lot of people who watch financial TV might not know that there is a substantial deadhead contingent on Wall Street. You are a musician yourself. You play in a band. And of course, I think a lot of people on Wall Street were mourning the passing of Bob Weir of the Grateful Dead over the past week. So I was just curious to get your thoughts and on and kind of what is a fascinating interweaving of music and Wall Street at times.
It's interesting. When we look at the markets, we think it's not just about mathematics, but it's about emotion. And if you consider that music is mathematics and emotion, a piece of sheet music is a mathematical equation that is interpreted by a player, by a musician. Our band happens to be a band that's very much focused, I'd say, on the pre-1980 era. Ike and Tina Turner, Allman Brothers, Rolling Stones, and Van Morrison. But our drummer, for example, plays in two bands, and he plays in a band that is well known for Grateful Dead tunes. We would say the passing of Bob Weir is most certainly a loss. We saw him as a bright light within the genre of music that the Grateful Dead play, and a brilliant musician. By the way, our band is called Exile on Broad Street because I named it such because Oppenheimer is one of the last very recognizable names that has its headquarters on Broad Street. Most firms are Midtown. We moved from Midtown to downtown about 12 years ago or so.
And there you are, still on Broad Street. So thank you so much for that, John. Always love talking music with you, so I appreciate it.
Thanks, Julie. Great to be here.
Take care. Coming up on Morning Brief, we'll bring you today's top trending tickers. Also, we'll be joined by the CEO of Klarna next. Now time for some of today's trending tickers. We are watching PNC, BYD, and Immunity Bio. First up is PNC, the regional bank reporting fourth quarter earnings ahead of the opening bell, and the stock is jumping. Profit topped expectations, and earnings were in line with Wall Street estimates. Those results driven by increased loan growth and rising demand for its financial services. Next up is BYD. Shares jumping in overnight trade on reports the Chinese EV makers in talks with Ford for a partnership. The focus of those discussions is around batteries. Ford would buy them from BYD to use in hybrid vehicles. That's according to the Wall Street Journal. The company is still figuring out the details, and it's also possible a deal would not come to fruition. Finally, Immunity Bio. Now, this biotech stock is extending its 2026 rally. It has doubled in value already this year, and it's risen every single trading day in 2026. The company's had several catalysts lifting shares. It reported preliminary earnings on Thursday, saying full-year revenue from its bladder cancer drug is expected to soar 700% year over year. Separately this week, the same drug got approval from the Saudi Food and Drug Authority to treat non-small cell lung cancer. Well, Klarna is pushing for a shakeup to the credit card industry following President Trump's call to cap credit card interest rates at 10%, calling the idea a win for consumers. Joining me now, Sebastian Siemiatkowski, Klarna co-founder and CEO. Sebastian, it's good to see you.
Good to see you.
It seems like this credit card thing is not going to happen at this point. It also seems like if it did happen, it could be good for Klarna. So given that it's probably not happening, kind of how are you thinking about it at this point? And it seems like it's been kind of a good marketing point for you guys this week.
Well, maybe I'm the only CEO of a bank that actually dares to talk about this topic because, we are one or maybe the only bank in the world who hasn't built our whole profit on the idea of putting people in making them revolve up to $5,000. Our average balance is $100, and not having them pay, 30% on revolving. That in the US in total generates $30 billion of revenue per year. So obviously this, in my opinion, very thoughtful and good suggestion from Trump to cut it to 10% would have returned maybe 20 billion of that back to US consumers. And it's not uncommon. We've seen interest rate regulation in Europe work pretty well.
There is one of your competitors, sort of a fintech startup called Gilt, that's now said they're going to come out with a credit card that has a 10% cap on interest rates. Would you guys be willing to do the same? Ours are 0% if you look at the buy now pay later product. And I think in general, I'm saying a credit card specifically.
No, we have a credit card as well that offers you to put on installments, single transactions at 0%. So you could do that. But I think, again, it comes back to, so the answer is yes.
The answer is yes. You guys would come out with a credit card at 10%.
Well, we would definitely consider it. I mean, I think, again, the question is, how do you construct a product that is healthier than the existing credit products? And one is to avoid revolving, and another one is to not try to make money by pushing people into debt and maximizing on the interest rate. So you have to find other ways of making money, or you just accept a slightly lower return on investment, which is what Klarna has done. I mean, in one way, you could call us a more affordable bank, means we accept slightly lower profitability. But what's interesting is when you do that, you get the self-aware avoiders, customers who actually have learned themselves the hard way that credit cards do pushes them into debt and are looking for alternatives. And those are very economically savvy and interested customers, and hence our losses are 30 bips lower than industry standards, with about 30% lower than industry standards. So because that audience is also more careful about their spending habits, and you don't make them max out. If you do make people max out, you're going to see higher losses.
By the same token, I mean, I've seen study numbers that say that using buy now, pay later does encourage people to spend more than they otherwise would, either buying more stuff or spending more on particular items. I guess what I'm saying is, what did they say about glass houses? Like, there's criticism of buy now, pay later, and how it potentially promotes irresponsible spending as well. So how would you respond to that?
Well, first, it's very important to know that the most money you can make in the world from marketing is to sell credit card ads and financial services ads, because these guys are willing to pay a lot. And so we have a very strange society where a lot of people are making a lot of money from promoting cards. And that in itself then may lead them to write more positively about credit cards as a product. There's also a lot of lobbying going on because there are tremendous profits at risk here. But the truth is that, and as I always say, look, I'm still offering people a form of credit. Credit can always and will always have the downside of occasionally leading people to overextending themselves and so forth. But what you have to ask yourself, is it a better form of credit than the traditional form of credit? And I would argue, everything else equal, if you either have a person using a credit card, putting all of their spending every month on that credit card and then revolving, leading to about $5,000 in average balance and 30% interest on that, as compared to using primarily debit, then occasionally using buy now, pay later with a fixed installment and a 0% interest, that is, with an average outstanding balance with us, which is about $100, that is a better outcome for society and for consumers at large. But I'm still fighting fire with fire, which is pretty effective. So I'm not selling debit cards only, right? We do offer debit cards as well, but we are offering credit. So obviously, there's always going to be issues with credit. And what we have to do is make sure that we offer this responsibly, following all the regulatory requirements, but also being thoughtful about how we promote and suggest the usage of our products to the consumers.
Sebastian, I'm curious about something. There's been a lot of fintech innovation over the past decade. You guys are part of that. You got blockchain, you got all stable coins, all kinds of stuff happening. Fast forward 5-10 years from now, what do you think the financial landscape looks like? How do most people bank? How do most people pay, do you think?
Well, yeah. I mean, we thought about that in 2015 when we pivoted in this direction. We sat down, we asked ourselves, where is the future going? And our conclusion was the future of financial services is going to be a digital financial assistant that looks at your spending, look at your day-to-day transactions, but also your mortgages and your insurances and all that. And basically, over analyzing it overnight, wakes you up in the morning and say, hey, I looked at your mortgage, you're overspending, I could save you $20, and I've done all the paperwork and negotiated a new one for you, so the only thing you need to do is say yes. At that point of time, will you care that mortgage was with Wells Fargo or somebody else? You won't. You'll be like, thank you, assistant, thank you for $20, I'm happy to take it. Can you fix my home insurance as well? So we concluded that that's the direction in which financial services is going. Now, this is like self-driving cars. I can't tell you when it will happen. I can only tell you that I'm very certain it will happen. And what it means that the excess profits that we have seen among retail banks are gonna go away. Because the excess profits that exist in retail banking today come from the fact that switching cost is high, come from the fact that we as consumers find these products complex, boring, don't put enough energy on researching and comparing alternatives, and it's hard to do so. With the help of AI, we will be supported in doing that, and that will drive down excess profits. And with the help of AI, it will be easier to switch bank accounts.
Sebastian,
you will ask your AI assistant to switch it for you. So it is the end of excess profits in banking that we're seeing, and fintech will contribute to that.
I mean, looking at the bank earnings we've gotten so far this week, it looks like we're still pretty far, though, from I mean, I did say 5 to 10 years, to be fair. But those profits are still alive and well.
That's very true. And that's, it's always like, it's always a question of, again, to your point, some people believe this is going to happen earlier. Some people would say it's going to take a longer time. I've been doing this for 20 years. To me, it's very clear that whoever dares to be the bank, just like Walmart was, just like IKEA was, these large companies that recognize that when they became bigger, when they reached scale, they took some of that profit and lowered their price it and make themselves more affordable. Whoever is willing to be that driving force in banking is the long-term winner. And that's what we're trying to be with Klarna. And over time, you'll have to sacrifice a little bit of profit, short-term profit for that, but you're going to build trust and the benefit of an audience that actually sees that you're, and then I don't know when did you last time hear one of those banks now as they report these amazing profits say, and as a consequence of this amazing quarter, we're giving this back in lower interest rates to our customers. Like I don't hear them say that. It's not happening.
You don't hear too many public companies generally saying that, not just in banking, but
True.
Yeah. All right, Sebastian, we got to leave it there, but we will talk again soon, I'm quite sure. Thank you.
Thank you, Julie.
Coming up on Yahoo Finance, opening bid, executive editor Brian Sozzi's joining us now. Soz, what's going on?
Julie, I wish banks after big quarters did give back some of those profits. I mean, why not? What, free loads, Julie? Let's go. Let's do it. It's Friday. Look, I'm all jazzed up about the NASDAQ. That's why I'm really excited. Seeing a little bit of rebound on NASDAQ. You were right to tell me in the morning meeting, Julie, that these tech stocks have not been doing well. I'm a little more optimistic on where they could go into earnings. We're going to break it all down.
I look forward to it. I love dropping knowledge on you, Soz. That's what I'm here to.
I'm here to soak it in.
You go way out there, and I try and rein you back.
I'm Sozzy Sponge. There we go. Just soaking it in, Julie.
All right, looking forward to opening bid, Soz. Appreciate it. That does it for Morning Brief.